Right now, somewhere in Dubai, a developer is selling apartments in a building that has not been built yet. In London, a foreign investment fund just purchased an entire residential block. Nobody who lives nearby can afford to rent in it. In New York, a rent-stabilized tenant is being offered a cash buyout to leave an apartment their family has lived in for 30 years. The building will be gutted, relisted, and sold to someone who will visit twice a year. And in rural Vietnam, farmland that sold for $3,000 an acre in 2015 is now listed at $40,000. None of this is accidental. All of it is connected. And all of it traces back to the same engine. The global real estate market. The single largest asset class in the history of human civilization. We are talking about $326 trillion in total value. That number is so large it barely means anything. So let us make it mean something. The entire global stock market, every publicly traded company on Earth, Apple, Saudi Aramco, all of them combined, is worth roughly $110 trillion. Global real estate is 3 times that. It is larger than global equities and global debt combined. And yet most people interact with it only once or twice in their entire lives, usually terrified, usually confused, almost always at a structural disadvantage. So let us talk about how this system actually works. Real estate at its core is simple. Land and the structures on it have value because humans need shelter, need to conduct commerce, need to store goods, need to produce things. The more people want to be in a specific location, the more that location costs. Supply, demand, geography. Basic. But the global property investment machine built on top of that simple truth is anything but basic. There are 4 major categories of real estate that drive the global market. Residential, which is homes and apartments. Commercial, which includes office buildings, retail spaces, and hotels. Industrial, which covers warehouses, logistics centers, and factories. And land, raw undeveloped earth, which is perhaps the oldest and most fundamental investment in human history. Each category behaves differently. Each has its own cycle. But all 4 are now deeply interconnected through global capital flows in a way that would have been unimaginable 30 years ago. Here is what changed. In the 1990s, most real estate was local. You bought property in your city, your country, with local banks, for local reasons. A pension fund in Oslo was not competing with a sovereign wealth fund from Abu Dhabi for a residential block in Sydney. That world did not exist. Then capital markets globalized. Interest rates dropped across the developed world throughout the 2000s and collapsed to near zero after 2008. Suddenly, money was cheap and abundant. And money looking for returns landed, predictably, on the most tangible, most historically stable asset available. Land. Buildings. Property. Institutional investors flooded in. Real estate investment trusts, REITs, made it possible to buy fractions of commercial portfolios the way you buy stocks. Private equity firms began acquiring single-family homes at scale. Foreign sovereign funds started treating London, New York, Sydney, and Singapore like asset storage facilities rather than cities. Between 2010 and 2020, global real estate values increased by over $100 trillion. $100 trillion of new value. Created largely not by building more homes or more productive spaces, but by the same land and the same buildings becoming more expensive. Nobody manufactured anything. Nobody invented anything. The earth did not expand. The price just went up. And up. And up. And somewhere in that relentless ascent, housing prices stopped being about housing and became about something else entirely. We will get to what that something else is in part 2.
2006, a mid-level banker at Morgan Stanley wrote an internal memo warning that the American housing market was showing signs of a catastrophic property bubble. He was largely ignored. 2 years later, the global financial system nearly collapsed. $8 trillion in housing prices evaporated. Millions of families lost their homes. And the banks that had engineered the collapse were bailed out by the governments of the people they had destroyed. The lesson the world took from 2008 was supposed to be caution. Restraint. A reckoning with what happens when you treat shelter as a speculative instrument. Instead, central banks cut interest rates to historic lows and kept them there for a decade. Which made borrowing almost free. Which pumped more capital into real estate than ever before in history. Which pushed housing prices to levels that made the pre-2008 bubble look modest. The lesson the market took from 2008 was not caution. It was that governments would not let real estate fail. And it bet accordingly. Now here is the uncomfortable math that sits underneath today's global property market. In 1980, the average American home cost roughly 3 times the average annual household income. By 2024, that ratio had climbed to over 7 times. In cities like San Francisco, London, Sydney, and Vancouver, it exceeds 12 times annual income. Mortgage rates matter here. At 3%, a $400,000 home is painful but manageable for a professional household. At 7%, the same home becomes structurally unaffordable for the same household. Rates moved from 3 to 7 between 2021 and 2023. The fastest increase in 40 years. Sales volumes collapsed. But prices barely moved in most markets. Which should be economically impossible. When demand falls, prices fall. Except when the people who own the supply do not need to sell. Institutional holders, long-term investors, foreign capital, they can wait. The family trying to buy cannot. And so the market froze. Not crashed. Froze. Unaffordable to buy. In many cities simultaneously unaffordable to rent. Now shift to commercial real estate, because the situation there is considerably darker. Office vacancy rates in major American cities reached historic highs following the remote work shift. In San Francisco, over 30% of downtown office space sits empty. In Chicago, over 20%. These are not temporary gaps. Many of those leases are not coming back. The buildings carrying those vacancies were purchased with debt. Short-term debt that is now coming due. Refinancing at current rates, with current vacancy levels, is not viable for many of them. Industry analysts estimate that over $1 trillion in commercial real estate loans need to be refinanced by 2026. In conditions that make refinancing nearly impossible without significant losses. The commercial real estate collapse is not a prediction. It is already in motion. Quietly. In the balance sheets of regional banks across America that nobody is talking about yet. Globally, the picture varies but the tension is the same. China's real estate sector, which at its peak represented roughly 30% of the entire Chinese economy, began its unraveling with Evergrande in 2021. That unraveling is not finished. European property markets are under pressure from energy costs, demographic shifts, and the end of the cheap money era. Emerging markets that borrowed in dollars to fund property development are now servicing those debts as the dollar strengthens and their currencies weaken. The entire architecture of global real estate was built on one foundational assumption. That money would stay cheap. That rates would stay low. That the capital would keep flowing. That assumption is now gone. And here is the question that the people running the largest property portfolios on earth are quietly asking themselves in private meetings that you will never be invited to. When the asset class that underpins more wealth than anything else in human history was priced for a world that no longer exists, what happens to the price? And more specifically, who absorbs the loss when it finally corrects? It will not be the sovereign wealth funds. It will not be the institutional investors. It will not be the private equity firms who bought 10,000 single-family homes in 2021 and have armies of lawyers and lobbyists protecting their position. History already answered this question once. In 2000